So just, running through the numbers today, of course, annual numbers, you're looking at impairments for the period of £126.8 million. And that, of course, a huge jump from the £10 million in the previous year. So walk us through where, in fact, you have chosen to make those losses when it comes to those paper-based losses, and to what extent that really is the reason for the overall loss when it comes to earnings this time around.
Good afternoon. Look, we unfortunately didn't choose to make the losses, but we definitely did make them. They arose primarily in two areas of the business. So the UK regional office market is showing record void levels at the moment, and we're quite heavily exposed to that market. Hence, the properties we hold in that market were impaired by 10.7% over the period from February this year to August of this year. Equally, as you would be aware, and that largely is, a lot of those properties are rented to the UK government, who, as you're aware, are imposing austerity measures. And where that's creating some vacancies and so on and so forth, both in our portfolio and generally. In addition, we're also exposed to shopping centres in the UK, so effectively to the UK retail market. Our properties in that portion of the portfolio declined by 9.4% over the period February to August. And again, really, that's a function of what's going on in the greater world economy. There were a number of retailers who went into administration during the period. There's continuous pressure to reduce rentals and service charges. Ultimately, that accounted for the vast majority of the impairments. There were obviously other parts of the business which performed quite strongly and with which we were very pleased, and which enabled us to maintain our distributable earnings at the levels we forecast in the prospectus, which in fact represented growth over the prior year.
Yeah. When it comes to the UK market right now, what is your focus? I mean, how are you going to manage, to move through a period where we still know there's uncertainty as to the direction of the economy, question marks around what type of quarter four GDP number we'll see, and beyond that, given the fact of the distorting, fact of the Olympics and the Jubilee celebration. So what is your strategy right now when it comes to those properties in the UK?
I mean, without using a trite term, a back-to-basics focus. So we've got properties in different sectors of the UK market. So, for instance, the hotel properties we've got are doing very, very well post the Olympic period. So where we really had some concerns that there was a lot of capacity introduced into the market, we might see occupancies falling post the Olympics. In fact, our portfolios continue to perform very strongly, and we're very pleased with that. On the regional office portfolio, which I've just spoken about, where we saw a significant number of impairments, that portfolio arose primarily as a result of our merger with a company called Whichford at the end of the previous financial year. We spent a large part of the current year restructuring the portfolios within that company and effectively removing a lot of those properties from our balance sheet. In our results announcement, we note that two of the major portfolios were successfully restructured post-year end, so in September and October, and a third major portfolio is in the process of being restructured. So hopefully, if we have this conversation in a year's time, we'll see significantly fewer of these properties on balance sheet. Yep. As regards the retail, the shopping centres, we're really in a process of defensive asset management. So where possible, we're doing refurbishments, we're enhancing the centres to maintain and grow the footfalls, which should help the underlying retailers and support the values of the properties.
And of course, an interesting part of your portfolios is your exposure to the Australian market through Cromwell. Just looking at the numbers there, looking pretty good, £22.8 million coming through in gross rental income. Talk to us about the prospects for operations in the Australian property market right now.
Cromwell is run by a very, very competent team. It's invested in very high-quality properties, which are either let to the Australian government or semi-government entities or to blue-chip companies. So the covenants on those properties are very strong. We expect to continue to see very solid cash flows arising from them. They're looking at a number of further acquisitions, a number of which are very exciting. So, it's a very safe banker. From Redefine International's perspective, it's obviously performed very well, both from a currency perspective, you take what the Australian dollar did against sterling, and in terms of the share price. So we continue to look for good growth from that investment and strong underlying cash flows.